All right. Hello again, everybody. This is Mike Rixey. I am the lead options instructor for Netpicks, and this is our options trade of the week. We will get to our new trade for this week in just a few moments, but I do want to cover our trade from last week. We did sell a call spread on Nike, symbol NKE, so I wanted to give you an update on that trade, what we ended up doing with that one here this week. It was a very quick mover for us. Wasn't necessarily expecting the speed of the move that we got this week when we initially put the trade on, but we'll take it. Certainly nice to be able to close out some nice profit here this week. Just a quick refresher, we did sell a call spread on Nike. Here's the chart pattern that we used to identify that trade. If you have not had a chance to go through last week's video, highly recommend that you do so. It does go through the trade a little bit slower pace, goes into more detail as to what we're looking for on the trade. But the whole basis for the trade was the overbought condition that we were seeing on this chart. And we quantified that by using our pulse indicator down at the bottom. Notice we had a whole series of yellow and even some green bars on that pulse indicator. What do those represent? The yellow bars represent between a 1 and a 2 standard deviation move on the upside. The green bars represent between a 2 and a 3 standard deviation channel move on the upside. In other words, we're extremely overbought. When you start to see these types of readings, it doesn't mean Nike can't head higher from here. It just means it's not statistically probable that it will. Chances are you're going to see a period of consolidation or even a reversal to the downside. And that's what we were looking to take advantage of last week. Now, why didn't I come in and just buy a long put option if I wanted to lean bearish? Because buying a put option would only give me one way of making money on the trade. Nike would have to move lower and it'd have to do so quickly. I wasn't convinced that that was going to happen. I was expecting more of a period of consolidation or a drift to the downside. Now, in reality, you can see what happened. It's been a quick move lower all week long. So selling the call spread, it did allow us to make money on this move to the downside, but we didn't need it. If we just have chopped sideways all week, we could have made money from the time decay adding up. So the basis of the trade was because of this overbought condition that we saw on the chart. And we came over to the trade page and we sold the November 15 monthly options and we sold the 97.5 100 call spread. It meant I was selling the 97.5 call and buying the 100 call at the same time. That made sure I was in a risk-defined trade. In this type of a market, very important. If you're wrong, it can get painful quickly in this type of environment that's so news-driven. So many headlines, so many tweets driving market action these days. Well, we collected 70 cents per spread. That $70 per spread was the most I could make on the trade. It tied up around $180 of capital. So very reasonable as far as cost goes. You can do that with just about any account size out there. Well, if I go ahead and unlock this price, you will see that coming into the end of the week, it's now trading for 10 cents. We now have $60 of profit per spread. You can close this trade out at any point in time. Now, why wouldn't I hold it? Why wouldn't I just hold the expiration and hope that the entire thing expires worthless? It would give me the full profit. I wouldn't have to pay a closing commission. The problem with holding it is anything can happen. There are still 21 days left to expiration. That's a lot of time. In this market, we have seen a lot of big movement in the blink of an eye. As we get closer to expiration, the time decay continues to pick up in our favor, but so too does the directional risk, known as the gamma. And if this thing reverses back to the upside, we could go from a really nice profit, over a 75% max profit. We could go from that level to a loss in a period of days. So to hold with that type of additional risk for only an additional 10 cents of profit really does not make much sense. I have already closed out of this trade. I highly recommend that you do the same. Book the profit, free up the capital for the next trade. It's going to be the best way to go. Your numbers and performance will improve greatly if you get out of these trades before expiration. We typically target between 50 and 75% of whatever we collected to put the trade on. So we can do that. We can close the trade out here today and keep that really nice profit. So congratulations to those of you that did take the trade. I've talked to a couple of you, so nicely done. Really nice profit there. You know, why am I getting excited about a $60 profit? Well, it only tied up $180 of capital to begin with, right? So I've got a nice little, 30+% return on my capital in less than a week's time. And it gave me 5 ways of making money on the position. I'll take that all day long. You start to trade multiple contracts. You put this trade on 10 times. right? You put it on 10 times and you've got just under $2,000 of risk. Now all of a sudden you're talking about a nice $600 profit. So really great way of trading. And it's a good way to transition into this week's trade of the week. I get questions a lot from people asking, why do I cover so many credit spreads in these trades of the week? And the reason for it, it's my goal to get more people interested in these types of trades. There are still so many people that get intimidated by credit spreads. They think they're too risky. They think they have the potential to lose a lot of money. In reality, the credit spread is the safest position you can put on. It's going to tie up the least amount of capital. It's going to give you the highest probability of success. It is a great complement to some of the other strategies out there. I'm not saying you should exclusively trade credit spreads, but I do believe it should be a big part of your trading on a regular basis. They are very forgiving trades. As you can see on NKE, they do provide some quick profit potential. But again, if Nike hadn't moved lower in a big way this week, I still could have made money from the time decay adding up. Now, there are times that I do like to buy long calls and long puts. I'm picky on when I do so. I want the timing of those trades to be pretty darn accurate because the moment I buy an option, the time decay is hurting me. And as that time decay adds up, it becomes harder and harder to make money on the position. Well, let's take a look at an example where we could potentially have a nice long put position setting up for us. Here's symbol DIA. This is the Dow Jones Industrial Average ETF. The index products have been tricky products to trade the last few months because we've had very little two-way price action to speak of. Markets continue to stay very resilient here. Anytime we get selling pressure, it might last for a day or two, and then we ramp right back to the upside. The Dow, however, has lagged behind here over the past week or so. It has not been as strong as the NASDAQ. We're certainly seeing more signs of a move lower on the Dow. I get it. The Dow only represents 30 stocks, so it's not that highly diversified product like SPY or like QQQ, but it still can be a nice product to trade. And notice down at the bottom, I've got my sentiment histogram. It's the red and the green histogram down at the bottom. Just over the past couple of days, we have seen that histogram go from green to red. That right there piques my interest on the downside. It's starting to show you that the bearish sentiment is starting to kick in. Now that on its own is not enough for me just to go in and buy put options. I have to wait for confirmation. And that confirmation comes from price action up top. Notice I have the red and the blue moving averages. Those are the 8 and the 5 period exponential moving averages. And then I've got a dotted white line. That's what we call our signal line. It's one of our custom indicators. It's a little bit faster moving than the moving averages. So it's a little bit more responsive, which is what we really like. What I'm looking for ideally, I want to see a crossover of the 5 exponential moving average below the 8. So we got that. We also got price action to stay below our signal line, that dotted white line. That's the confirmation that I'm looking for. Now, the last step in the sequence is I need price action below 266.29. That could very well happen today. We'll just have to wait and see after the market opens as we go into the weekend. If we get any type of selling pressure at all and price action breaks lower, if we hit 266.29, this trade is very valid. I will certainly look to put this position on. So again, I don't want to jump the gun now. I can't just jump in right at the open. I have to wait for price action to break below my pink lines. That's my entry point. Because if I don't see price action break lower, we could very well see a head fake and see this thing reverse right back to the upside. So I am waiting for price action to confirm on the downside. But if we hit 266.29 here today, let's jump over to the trade page and walk through this. I am going to use the November monthly options. They have 21 days left to expiration. When I am buying options, I typically look for between 20 and 40 days left to expiration. That's the sweet spot. By going out that far, I am able to limit the time decay somewhat when compared to some of the shorter term weekly options. And I'm also able to give myself the benefit of gamma working in my favor. And gamma, again, tells you how quickly the options are going to change when compared to changes in stock price. The options become more reactive the closer we get to expiration. So the sweet spot where I can limit the time decay and still have some directional movement in my favor is that 20 to 40 day window. In this case, the monthly options are going to have better liquidity. We're going to have higher volume, higher open interest. That's going to make it an easier cycle for us to trade. And that's that way in most products that we look at. I'm not opposed to the weeklies. You just have to be careful with them because at times the weeklies can be difficult because of the lack of liquidity. If there's not enough volume and open interest, it makes it more difficult to get filled quickly and at good prices. So again, our entry on the downside is 266.29. What I want to do ideally is to get slightly in the money. So on the put side, if our entry point is right around 266, if I go to the 267 put, that gets me slightly in the money. I could even go to the 267.5 put. In most cases, I like to go 1 to 2 strikes in the money. Now, in this case, if I compare the open interest numbers, if I compare the open interest of the 267 put to the 267.5 put, the 267 put has 500 contracts of open interest. The 267.5 put only has 53 contracts of open interest. That 267 put is more active. There has been more trading on that contract. The higher the open interest there, the easier it's going to be for me to get filled, both getting in and out of the trade. If I buy that put option right now, they're currently trading for between $250 and $270 per contract. I'm going to end up paying a little bit more than that because we haven't hit the entry point yet. So I'm most likely going to pay just over $300 per contract to put the position on. A little bit more risk than what we've been talking about in recent videos using the credit spreads. Long puts, long call options, they're higher risk, higher reward scenarios. So yes, I'm going to pay more for them up front, but if this trade does move lower, I have the potential to make more money. So it's a nice trade-off. It's just I don't want to use this type of a strategy all the time. This can't be my only strategy. This is a good complement to some of the other credit spreads that we've been talking about lately. And I don't mind taking the additional risk. Again, risk management is crucial. Regardless of the strategy that you use, you want to keep that risk in that 3 to 5% range of your account per trade. You don't want to go over that. If you start to go over that, you're going to see bigger swings in your equity curve, and it's harder to manage, especially when you hit that drawdown. Have a couple of losing trades. If you're taking too much risk, it's really difficult to stick around and get the numbers in your favor over the long haul. So as long as I keep my risk at a manageable level here, between $270 and $300, that's manageable. We can do that. Now, how do I manage the trade? What am I looking for here? When I buy long calls or long puts, my initial target zone is a 100% return. Just to keep things simple here, let's say we get filled at $300, $3 per contract. My initial target will be $6. I'm looking to close that position out for $6 per contract. That would give me a 100% return. Doesn't guarantee I'm going to hit that level, but that's my initial target zone. I can always adjust it from there. If we don't end up getting the follow through on the downside, maybe I get out with a 50% return. That's still going to give us a really nice return. So I have to have a starting point, and my starting point is that 100% level. On the risk side, I am only willing to risk 50% of what I pay for this option. Bottom line is we're going to be wrong at times. It's part of trading. The key is to limit the damage on the trades that go against you. When they happen, if we can limit the damage, it'll allow us to battle back much faster. If I get into this trade for $3 per contract, I am going to limit my risk to $1.50. My maximum loss on this trade will be $150 per contract. By taking that approach, if I limit my losses to 50% and I'm targeting 100% on the return side, what I'm doing there is I'm building in a positive reward to risk ratio. If my winners are larger than my losers, it takes the pressure off that winning percentage. I don't need a 90% win rate to make money. Okay, that's the key piece. When you're going to buy long calls and long puts, you've got to track that reward to risk ratio very closely. That's going to be the key to successful trading over time. So again, we're going to buy a long put here on DIA. It is a bearish position. We want the ETF to move lower. That's the only way we make money. We need it to move lower, and it needs to happen quickly because every day I hold this position, the time decay is adding up. The time decay is going to be hurting us. I'm willing to take that risk because what I'm banking on is the move lower is going to be big enough to offset any of that time decay and then some. So we'll track this over the next couple of weeks, see if we can finally get this market to roll over. It's very, very overbought here. We've seen an incredible run right back up near the all-time high, so I am expecting a move lower. If you're interested in this trade this week, just make sure we do hit 266.29 before you buy those long puts. And then I'll be back next week. We'll take a closer peek at this, give an update, see where things are at, see if we triggered in. If we did trigger in, we'll take a look at the P&L at that point. If you have any questions on this position, feel free to post a comment here inside of YouTube. You can post a comment on our blog post or send me an email directly to mike@netpicks.com. All right, so I'm going to wrap this video up here. Enjoy your weekend, everybody, and I'll be back with you next week for our next options trade of the week.